Hello, everyone, and welcome back to the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman, and with me once again today is Nick Giulioni. Nick is a local investor. He's the owner of Offleash Construction here in Indianapolis and a lot of other things, but welcome back to the show, Nick.
Yeah, thanks for having me. Excited to be back.
Yeah, so how's life as a general contractor?
You know what? It's way different than I initially expected, but it's definitely a fun one. We get to do just all the weirdest things and solve people's problems. Honestly, probably not that different from kind of what you guys do from a property management perspective. We're just problem solvers.
Yeah, that's exactly right. I always tell people the way you can show value with our company is you solve problems. Like that is the number one criteria, I think, because there's a lot of problems in what we do, and really a lot of businesses probably. So Nick, you've been on here before, but just a quick recap for everyone. Tell me if I'm wrong. From California.
You nailed it.
Started investing in Indianapolis.
Mm-hmm.
You moved here during COVID?
I did, yeah, in 2020 when our jobs went remote. Ended up coming out here. Yeah.
And now you're a general contractor.
Amongst other things, yeah. Sounds like you've got a pretty good summary there.
Now I'm going to embarrass you a bit.
Okay.
I didn't tell you about this, what I was going to bring up today, but
all right.
I was looking at your LinkedIn account a while back, and we talked about this. We had lunch recently, and I brought this up. But you were I have it somewhere here. I think it's still on one of my tabs, but you were at Corsair?
Yeah.
You were the 2018 Rookie of the Year and company-wide push-up champion.
Yeah. Every year they would have a sales conference, and I believe that this was it's the second one of these that I went to where I won the Rookie of the Year. And there was a guy there that I swear, he was from the UK, but he looked like Captain America. I've never been more proud to beat anybody in a push-up competition in my entire life.
So you guys actually had a push-up competition at a sales conference, you said?
Absolutely, yeah. All the sales guys from across the world come out there. We learn about what's coming, market trends, and then we drank and ate and did push-ups, and it was a whole thing.
So tell everyone how many you did and how long.
I think it was high 70s or low 80s in a minute.
In 1 minute.
Yeah, no, I can't do that anymore. I'm much older.
That's incredible. That's more than one a second, obviously. So you were pushing.
I was motivated. I think there was a $100 prize, so I was definitely motivated. You put a money incentive in front of me, and I'm gonna find a way to win.
Yeah, I think that's interesting. I definitely would have put that on my resume, but I can't, or my LinkedIn account, but I wouldn't even be able to get close to that, even my prime. So I actually did push-ups this morning, and it kind of got me thinking about it as I was thinking about the podcast. But all right, so today, Nick, I brought you on here not to talk about your role as a general contractor, but as an investor. You've done a ton of it here in Central Indiana. And I think you have a good story about kind of what you're doing with your portfolio. I caught wind of this. I don't know exactly how. And you and I shared an email about, hey, what do you do? I'm just curious. I never like to see people sell real estate. Maybe it's my own thing. I've always been a buy and hold person. But at a very top level, tell everyone what you're doing right now with your portfolio.
Yeah, the best way to describe what I'm doing is I'm rebalancing. Kind of the quick and dirty background is I began investing out here in 2017. And I had the wrong measurement back when I got started. What I was looking to do, I would write down in my goals every single morning that I wanted to get up to 1,000 doors. I got up to, at my peak, about 70, 75 doors. And at that point in time, my life sucked. You're constantly dealing with problems. And as we've talked about in the past, haven't always had the best team members in my corner. And so things were just harder when you don't have the right people supporting you. So had all of that going on. And when I was measuring door count, I wasn't measuring quality. And I was able to use creative finance. I was able to really out hustle and outwork most people in the room in order to get to that number. But then once I got up to 75 doors or whatever it was, I realized that they made me pretty unhappy, and they weren't nearly as profitable, especially if you don't have those team members, as my spreadsheets initially indicated. I think it was by 2020, I got up to that peak of doors.
So in 3 years, you got up to about 75 doors, let's say.
Give or take, yeah. And, constantly shuffling, selling some, buying some. But in the grand scheme of things, it took me about 3 years to get there. And there were a lot of problems along the way. And, back in 2020, or honestly 2017 up to 2021, you could, walk by a house and it was going to increase in value. So
Sure.
I was able to benefit from a lot of that over that time period. And it was earlier this year that I was sitting there and, I thought I had actually sold off or lease optioned a portion of my portfolio to somebody at the middle of 2024. Unfortunately, that didn't end up working out, and those properties came back to me, and I just didn't want to deal with them again. And so began figuring out, all right, what are the doors that I don't want to own anymore? What doors do I want to own? What do I want my strategy to look like long term? And began taking action on that. That's kind of when you reached out.
Yeah. So I'm curious, take me back to 17.
Yeah.
You said it was 1,000 doors. So did you have any like buy box? Did you have any like, I want this to sort of like pro forma cash flow, price point? Tell me what your thought process was back in 17.
Yeah, I wanted cash flow neutral is kind of where I was at. I was focused, as we've talked about, and I'm sure you've said about 1,000 times on this podcast over the years, there are multiple ways you make money in real estate. There's obviously the cash flow piece. That was the least important. I was employed at the time, so the cash flow actually wasn't super important. I had, you've got appreciation, you've got loan pay down, you've got the tax benefits, and you've got the inflation hedging. I was kind of counting on the other four to make me wealthy. And, I think that there were some other factors that went into my decision making and what my buy box was. At that point in time, I was looking for either portfolio acquisitions where I could add value. Generally speaking, you're able to acquire a portfolio at a discount versus if you were to buy them individually, because there are fewer buyers on the other side of that transaction. And then the other thing that I was looking for were BRRRR opportunities. Were there opportunities for me to go out there and do the value add and minimize my out of pocket on a per transaction basis? For the most part, at that point in time, 2017 to 2020, you were largely able to kind of pull off 1% type deals where the after repair value was very similar to 1% of the rent.
Yeah. Yeah. So that's what you looked at. And then, so you're starting buying these, and sounds like you got them from a lot of different places. Maybe like you mentioned, you got really creative and just bought creatively and maybe at discounts and hustled basically.
Yeah. That was how I got there. And it was wildly productive.
Right. And you did this remotely for the most part, right? Were you building most of your portfolio remotely? Right.
Yeah, until 2020.
So how many doors did you have at 20? Well, that's your 75 doors at 2020, right? Yeah. And that's when you moved out here. Mm-hmm. And I'm just curious, like living 2,000 miles away-ish and having an idea of what your properties look like. I'm sure you made some trips out here maybe, but then you moved. Not as
many as I should have.
Right. Okay.
Yeah.
And so you get out here though, and you start immersing yourself in central Indiana. You started getting a better feel for, these are the good areas. These are maybe not the areas. Did you have some realizations back then that I'm not saying it was all bad purchases, but were there some of those moments where you're like, I never would have bought this had I known what I know now?
Oh my gosh. Yeah, absolutely. There are so many properties that in my head, I thought they were B-class assets and they were C.
You were told that probably too.
Oh yeah.
Right?
Yeah. I was trusting the people who were making money on me transacting.
Right.
Yeah. Big mistake in a lot of cases. But, and again, that's where I circle back to having more people in your corner, having more people kind of supporting you, incredible property managers that can essentially have that conversation with you, incredible contractors, incredible agents. You need that entire team of people. You want as much diversity in your team as you possibly can with different incentive structures. A great PM, honestly, if I'd been working with somebody like a TNH at that point, they probably would have stopped me and been like, hey, I know you think that you're going to get 1,500 for this one. You're probably going to be at 1,300 or whatever the number was in those. And so for the most part, I don't think I was getting the best advice and was trusting a little too much.
Yeah, that's something I watch, Jake Knight, our business development manager, I see some of his emails go through, and that's one of the, if you ask Jake, like, what's the most common question you get when someone comes to you, like the first touch with our company is, how much will this property rent for?
Yeah.
Like, that's probably the number one question he gets. And I'll be honest, Nick, more times than not, he goes back and says, you're not going to get that.
Oh, yeah.
And here's why, and here's what you're probably going to get. So people say, well, that doesn't make sense because no, that does make total sense for us because one, we can't perform on it. If Jake gives them a number, just, okay, yeah, we can get that and we can't, that loses trust.
Yeah.
So we want to give people a realistic expectation. And I think the word no builds a lot of trust with people.
Absolutely.
Like you can't do that. Right. And
Yeah.
so it tells them like, well, you're motivated to bring this property in. So if you're telling me it's not, you're basically shutting this property down from my pipeline.
Yeah.
Then I trust you. And I think that happens a lot. And that's the way it should work, is that everyone's working in the client's best interest, which is the buyer, and setting them up for success. Because if we get them if we have a buyer set up for success in our system, we're set up for success. So I think it just works together that way.
And it might be a slower scaling with them, but it's going to be a much more profitable scaling. And so I think that's brilliant.
Yeah. So let's talk about this decision. Was there because this isn't like the first time you've bought and sold properties.
No.
Because you own a wedding venue in Brown County and beautiful place. And so you've done some of this before where you've reshuffled some assets into different asset classes. But what was it about earlier this year you talked about that just said, was there a trigger point that said, okay, I've had too much of this, and finally the straw that broke your back, and just I'm doing this and I'm going full head in and rebalancing?
Yeah. So you alluded to something back in 2022. That's when I went full time into real estate. A hedge fund came and offered me way too much money for 17 houses that I owned out in Avon. They were all identical houses on in a little community thing. And I just had them appraised for 165 a piece. The hedge fund had come and offered me 183. And so I was like, great, take it, enjoy. And that's when I went about the 1031 exchange. And that was the first time I did any type of major exchange. And that's when I bought the wedding venue down in Bloomington, where I converted. We ended up needing to buy up to $3 million worth of real estate based on that transaction. Right. And, happened to stumble across it, fell in love with it. And, on that, $3 million of real estate in the rental market, I might have been able to generate, let's call it $300,000 if I'm doing everything right in rent. I very quickly realized I was able to go, and now granted, much more overhead, not even the same comparison,
right?
But I was able to generate north of $800,000 of revenue based on buying a wedding venue. And so what I saw there was something that was kind of magical. And it's that once you have equity, it's much easier to turn equity into cash flow than kind of the other way. It's hard to turn cash flow into equity, and hard to turn cash flow into more cash flow is generally what I was finding. And so that's what was the initial seed that was planted in my head back in 2022. Loved that, love owning those wedding venues. And so you asked about what the straw was that broke my back. And that was these 26 properties that I thought I had lease optioned to somebody. He was going to purchase them in a couple of years. Really wanted that to work out. Was trying to set this individual up for success. Unfortunately, financial situation changed, wasn't able to go through with it. And so I got back these 26 properties, or 26 doors. It's fewer properties than that. I don't know. It's like 15, 20 properties, let's call it. And unfortunately, I saw some deferred maintenance. I saw a lot of these things. And I immediately went in there and was fixing all of them and realized that, given my history with poor property management in the past, and maybe some poorly trained tenants, and just some bad taste in my mouth at this point, I just didn't want these anymore. I thought I thought I was done. And at that point, still just wanted to be done with these ones. Now, to be clear, I don't want to be done with real estate. I just wanted to be done with these particular properties, these types of properties, and move into something different.
So the 26 doors, how many other doors did you own outside that you said, weren't part of that 26?
Ballpark, let's call it another 25, 26.
Okay. So you're around 50 doors then is what you owned, and you had about half of them, let's say, you thought kind of locked up on a contract purchase and you were going to be able to move them. So when you got those doors back, you're like, okay, now I have double the doors again. I'm back to where I'm like 50 doors or whatever it is. I'm just curious, what does Nick today want to buy versus Nick when you first started from California? What is your ideal property that you're looking to transition? Probably not another wedding venue, but maybe. I just when you look at it that way, what is your goal now, I guess?
Yeah, the quick answer is things that are more hospitality based, or at least much higher end. I think that there are a couple of areas that I've seen success. I have a couple of houses that are long-term, midterm, depending on kind of the season, up in Fishers, and those tenants are easy to deal with as compared to my $1,100 rental. Something that rents for $2,000 a month is a much easier client. Yes, the expectations are higher, but they're a whole lot easier to work with. Over the last several years, I've also built up a small portfolio of short-term rentals that now the pain in the butt factor is quite high with short-term rentals, but built a team up to help support from that side, and there are incredible property managers out there who can handle that. But again, what I've been able to do up to this point is convert some of that equity into greater cash flow. So for instance, I've got a property on 76th Place. We call it the Offleash Oasis. We've got, I'm going to have to show you photos at some point. It's beautiful. We've got like dog bowls built into the island. It's so cool. And that's an Airbnb that generates, I don't know, $6,000 or $7,000 a month, on average across the year. And it's worth about $350,000. So I was able to, again, the math isn't the same because there's so much more work that goes into it. There's so much more hospitality that goes into it than a traditional, 1% deal that you'd see on a long-term rental. But yeah, that's what I'm kind of looking to convert into personally. I have a superpower in that my cost of construction is going to be lower than most people, given the fact that I run a construction company. So I'm looking for, the ugliest houses in the nicest areas is kind of my approach at this point.
So you're trying to do single family, like you're selling duplexes, you're selling some single families, and you're kind of trying to convert into what I hear from you, mostly higher end single families, $2,000 more a month in rent, or has really good short-term rental upside, as opposed to grinding in the $1,100 a month rent where the residents may be more difficult. I think that's an interesting point, maybe a different podcast. Yeah. Honestly, some of the worst residents we've ever had have been in higher end properties.
Oh,
and
really?
Owners too. Yeah. But I'm sure we've had, they're equally distributed in our minds. Like there's difficult people at every price point and things like that. But so that's what you're looking for. You're trying to do kind of like this, sell a duplex, buy a really nice single family is your mindset.
Yeah, for the most part. I mean, I've picked up a second wedding venue. I don't know if you knew about that one, but yeah, I've got two. I'd pick up a third if the opportunity was right. Opportunities come to me all the time from that side of the house. But yeah, largely that's been my approach. And getting back to the kind of the higher rental things, one of those biggest expense line items, if people are actually doing their math properly, is CapEx and repairs. That should be, 10, 15, depending on the age of the home, 20% of your projected rent on a regular basis. The thing is, a water heater costs the same in an $1,100 rental as opposed to a $2,000 or $3,000 rental. The roof generally costs largely the same. And so it's one of those things where the percentage of expenses goes down a decent amount. Yeah, your mortgage goes up. Yeah, your rent to value tends to collapse a little bit. But I have found that the headache factor, at least in my limited experience, I'm definitely not at the scale that you guys are operating on, has been a little bit lower. Yeah,
that's good. We have a side story. You got me thinking about a property we owned on Kingsley Avenue. Okay, Sobro neighborhood. We bought several homes on Kings. I think we still own one or two, but it was a kind of an oddball. It was a 4-bedroom, 2-bath, 2-story in South Broad Ripple. You don't see a lot of those. There's a ton of bungalows, finished attic type stuff, a lot of that stuff. But this was a proper 2-story, 4-bedroom, 2.5 bath. I don't remember exactly. And Scott and I decided to sell. We did like 2 or 3 turns on it. We're like, no, this is like too expensive to turn all the time. So we consciously made a decision to sell that one because it's when you turn a 2.1 900 square foot home in South Broadville versus a 2.5.
Oh my gosh.
That's, 2,000. It's just, the cost is a lot different. So, it was kind of an outlier in our portfolio because it was so much bigger that we decided to offload that. But so talk about, you make this decision, you get all these properties back and you're like, I'm selling. So tell me about that process and I'm guessing you didn't put all 26 doors on the market at the same time. Maybe you did, but
no, I did not.
I guess, Yeah. So talk through that process.
Yeah. So generally speaking, most of my properties within that 26 units were relatively close to one another. So I sat down with an agent and I had a conversation with that agent about, all right, like, I don't want to flood the market, but actually, taking a quarter step back, I think the most important thing is understanding what's the most important to you. In this scenario, the most important thing to me was maximizing value and moving moderately quickly. If I had wanted to move very quickly, I could have done that, but I probably would have reduced my value that I would have gotten out of these things, because I've built up significant equity since 2017 on most of them, or 2018. I think the majority of them I purchased back in 2018. So, I was kind of looking at that and said, all right, let's line it up. Let's figure out what the order of operations are, what's likely to cannibalize each other. And then let's start running some experiments, because there's, we've got a ton of doors here. Like we can kind of, A/B test. So we would put one single family on the market and one duplex on the market. And because we wouldn't want two duplexes within a block or two of each other to really cannibalize the same investor at the same time. And generally what we saw was that the duplexes did incredibly well. Nice. They tend to still trade at the 1%, if not slightly higher, or slightly worse than the 1% rule. So, 0.9, 0.95 in that ballpark. Single families, unfortunately, rents don't tend to keep up in the single family to justify anywhere near the 1% rule. And so transparently, my single family game has been terrible. Just absolutely awful. And I don't think I've sold a single one that we've put on the market at this point.
No single families you've sold
that are tenanted, correct?
That are tenanted, right? Okay.
Yeah. But the duplexes fly either when both sides are occupied, or actually when one side is not occupied. It seems like there's a huge house hack contingent out there right now.
Totally.
That are looking to minimize their housing. And so those actually tend to trade at an even slightly higher number if there's a single vacancy on a duplex, because somebody's able to, if it's livable, it does tend to actually trade slightly better than I was expecting.
Yeah, literally Scott and I had this conversation yesterday, because we own a lot of duplexes. And, we're talking about, I've been very transparent, like, we're going to be aging out of our depreciations. Like, what do we do with these properties? And I said, I think it makes sense to do exactly what you said. Like, our duplexes, if one side becomes empty, let's turn it, let's rehab it, or, turn it like we normally would, but let's just leave it empty, sell it, because I think you're right. Just because of the affordability gap right now, people, it may not be their ideal situation, but they're like, I can get in this house, I can become a landlord, I can kill two birds with one stone, and I can, offset my mortgage a little bit. So that's super interesting. So are you getting people that actually do it, or are these just investors that say, well, I'll just fill one side?
No, we're getting house hackers.
You're getting house hackers.
Two of them. And they're actually doing the whole FHA. They're going through that whole process, which is its own challenge. But sure, absolutely. They're both of them that have had a single vacancy have gone to highest and best. So, when a transaction is, you get multiple offers within, the first little bit of time, then you just reach out to all of them, all the agents, and say, hey, I need you to submit your highest and best. And in every single situation there, the winner has been a house hacker.
Wow. Yeah. That's great. That's a huge tip, I think, for people that are looking to sell duplexes, is like, the rule of the conventional wisdom, I'll call it, was always like, let's get it occupied. It's just take over, turnkey investment, start cash flowing immediately. But I think you're right. I think our market is different. And I like the idea that, like, you're doing that, because I think it makes a lot of sense. So you're having some success. You're selling. I'm curious how you said the market's treated you okay, at least from the duplexes standpoint. But I just read something in Zillow that says Indianapolis is officially a buyer's market today.
So right? I've noticed a couple of things that validate that. The inspection responses have been aggressive from many of these people, making big asks. And thankfully, I think there's probably still an undersupply of small multifamilies out there. So I've been able to push back a decent amount, but it is something that we're definitely seeing, is the asks are getting pretty crazy in a lot of these.
Right. And how old are these homes on average?
Oh, these are like 20s, 30s built homes. So they're probably
100 years old
for sure.
Yeah. And
Like, hey, you do a sewer line inspection, there's going to be offsets. There's going to be some
sure.
bellying. That doesn't mean that you've got a failed sewer line by any means, but I've had several that have asked for entire new sewer lines. I'm like, no, we'll jet it and we'll make sure it functions, but we're not going to replace it just because, there's
It's not perfect.
some signs of age at this point.
Yeah.
Same things with foundations. We've had some people make some crazy requests. This house is 100 years old. There's going to be some settling in a home.
Right.
And
Absolutely.
thankfully, we've been able to do all right there. But like I said, the single family space has just been awful. Absolutely no traction because that rent to value isn't there. And I don't think it's doable from a rental perspective.
So is your philosophy maybe to withdraw some of these listings, wait till they vacate and sell them? Is that conversations you're having?
Yeah, you absolutely nailed it. So it's going to be a slower process on the single family side of the house. But yeah, that's exactly what I'm going to do is as leases expire, non-renew, and then move people out.
Yeah. So you're no stranger to 1031s, right? I mean, you've done that before. So Tell me, are you using 1031s now, or are you just going to bite the bullet?
I'm just going to bite the bullet. I've got a lot of passive losses and all of that. I probably at some point will do some level of 1031, but at least for these first several, I haven't. And I'm just going to pay the taxes on it.
Yeah, interesting. I mean, if it's going to be a slow roll, you kind of have to, right?
Yeah.
I mean, because there's time frames involved in there. So, all right. So you were 75 doors. What do you want to get to? Like, do you have a number? Like, I would
10.
love to own 10. Wow.
I would love to own 10 fantastic properties, and they might not all be single families, but 10 higher end properties in nicer areas where I'm not going to deal with stolen AC units or copper being stolen out of my electrical if there's a vacancy for a week. Yeah, kind of, north side of Indy, Hamilton County area, Brown County. But yeah, that would kind of be my target personally, is fewer headaches and fewer things that I need to be thinking about on a regular basis. Yeah.
So you don't have to give me numbers, but if you look at what your asset value was at 70 some doors versus those 10 doors, what does that look like?
Going to be hard. Yeah. It may not actually be achievable, but owning a wedding venue, everybody can look up the Wilds wedding venue. It sold for just a hair under $4 million. So that's one door technically, or kind of three doors. So like if we're just talking about, again, that's the danger of talking about door count, and necessarily is not all doors are created equal. Not even all A-class doors are created equal.
Yeah, that's true. So wow. So from 75 to 10 is your goal. That's
the goal. Hopefully we can pull it off. And if I end up with 15 or 20, it's still a huge reduction in headaches for me.
Yeah.
For a long time, 1,000 was a vanity metric. 75 was a vanity thing.
It's a lot.
But at a certain point, you have to understand what your goals are and like what you're actually trying to achieve, and what long term I want to achieve is with the fewest headaches possible, financial independence through real estate. And that's really hard to do with a lot of C and D class assets.
Yeah. Last question, I'll let you get going. But how much has running off leash changed your feelings or goals around real estate?
Oh, so much. And in so many ways that I never, ever predicted. So I get to see a whole lot more of these C and D class assets as we do the renovations for these people. And I see all the headaches. I see the problems. I see what could be coming my way in a lot of these situations. And so from that perspective, I've been scared off in my own way. Two, I've seen the demand for those assets just with our client base and the number of people looking to acquire the value add type assets that we're talking about in these areas. So that's definitely impacted it. But then number three, like I said, is I have a superpower in that I have the ability to go take on bigger problems than most people. I see a bad foundation. I see a bad sewer line. I see a knob and tube wiring, and that gets me excited. Most people that scares off.
That scares people, yeah.
And so for me, that's my objective, is to go find all of those problems in these higher end areas, which they exist. They definitely exist. I'm doing one in the kind of the north side of the Butler Tarkington area right now. Just lots of that kind of stuff. And so I yeah, I would say owning off leash and running off leash has taught me a lot. It also is a huge headache in and of itself. It's a lot of babysitting that I have to do of many different types of workers. And so maybe I have less patience today for dealing with pain in the butt tenants than I would have if I wasn't running a construction company where there's so much babysitting on a day-to-day basis.
Yeah. I guess let me just follow up on that a little bit. Do you think the because off leash is an ongoing thing. There's like a lot of stuff every day that you have to deal with. There's people you manage. There's tons of projects you have to like, maybe you don't go to manage all of them, but you probably have, some say so or some awareness of things that are going on. That takes bandwidth. It takes a lot of bandwidth from someone. And was it more of real estate was becoming a pain to you? And you wanted to focus because this is your baby now. This is something you love doing now. My guess is that may change down the road because you seem to be a guy that, can get bored and maybe want to do other things. But is that part of it or no? Was it just like, hey, this is something I did, I enjoyed it, and I still want to do it, but I don't want to do it the same way I was doing it before?
Yeah, it's more philosophical than I thought we'd probably get today. But yeah, I think you're right. I'm somebody who definitely is generally looking for a new challenge, a greater challenge pretty regularly. And so that's definitely something that has been a struggle for me. That said, I think I'm in a really blessed position that for the vast majority of our clients, I actually don't know their name. I don't know the address. And here at Off Leash, and I think that's a really good place to be. Where I think if you have to know every client, then you're not actually running a business. You have a job.
No.
And so I'm continuing to try and push to the point that I never have to know any of them unless I choose to. And so I think we're getting pretty close from that perspective. I am continually learning the things that my math has gotten better from an owning real estate perspective. It's gotten more realistic than it was when I wanted 1,000 doors. And for that reason, I think I'm making this shift. I don't think it has as much to do with the stress of off leash, although my wife might argue. So who knows?
Yeah. Well, it's been great. I talked about, I think had Scott and I, we started third party property management, and we never had like a number of we want to own 100 doors or 1,000 doors, anything like that. But I do wonder if we'd have managed our portfolio differently had we not been so involved with building a business. But that's a different topic and a different world, I guess. But well, Nick, I appreciate you coming on here today. It's been interesting to watch your journey. Hopefully you get to those 10 doors and you'll love them and life's good. You continue to grow off leash. But thanks for coming on here. I appreciate it.
Thanks for having me. I appreciate it.
Yeah. Let me ask you this. If people want to connect with you, how do they do that?
Yeah. Best way to get in touch with me is either on Instagram, which is at Nick Giulioni, or nick@offleashconstruction.com. Would love to help people with their investing journey, or if they want to learn about construction or just about any of it.
Yeah, that's great. We'll be back in 2 weeks with another podcast. In the meantime, thank you so much for listening, and please stay invested in your investment.